What's going on? Alex here, and today I'm answering your financial planning questions from Reddit. Now, today's question comes from Danny M094, and it says that he's confused on how retirement works. I'm confused on how you save about $1 million, and then there's this 4% rule you have to follow, so you end up using only $40,000 every year. Why just 4% usage if my stocks and investments will keep growing past the first year of retirement, or am I selling everything in my portfolio to start retirement? Another part of using $40,000 a year that confuses me is why I'm spending less yearly than I spend throughout my employment. Side note, I'm new to retirement. Aren't we all? Retirement is one of these things that has been generalized so much in the media that the word really doesn't mean anything anymore. On one hand, retirement for somebody might be that they just sit at home and sip pina coladas by the pool and relax in the sun. For other people, retirement means that they're working part-time or they're managing several businesses, but they're not putting too many hours in. They just come in at the end of the week, go to the weekly meeting, collect a paycheck, and be all set there. For other people, they just want to be on a boat in the middle of the ocean for retirement. But whatever that means for you, there is a 4% rule that's often touted in the financial planning and the investment space, and I'm happy to provide some insight as to where that comes from and the idea behind it. So the 4% rule is meant to avoid a drawdown of assets in retirement. I'm going to explain what that means. So if you start off with $1 million in retirement, okay, there's going to be the expectation that there are going to be some investment returns on those assets on an annual basis. Those are going to come in the form of dividends, interest, and capital appreciation, right? Because the value of the investments is generally expected to grow in most circumstances, depending on the market. But that's generally the idea, is that the value of the investments goes up and to the right, so to speak, so it increases over time. Aside from that, you have dividends and interest that are increasing the size of the account, and you can always invest those dividends and interest by buying more shares, and then that should fuel further capital appreciation in your account, theoretically. Assuming the market cooperates, that's never a guarantee. Now, the idea is that once you accumulate assets throughout the years that you're working, you want to get to the point where you can live off the income generated by those assets, but you don't want to get to the point where you start to draw down or decrease that $1 million to $900,000 the next year, and then $800,000 and $700,000, because the risk there is that you may run out of money. And one of the worst outcomes in financial planning is when you run out of money while you're still alive. The idea is not to be at zero when you're 72 years old. It's not an attractive outcome. So that's the idea behind the 4% rule. But you might say, wait a minute, Alex, what are you talking about? The stock market has much higher returns than 4%, so why are we limiting ourselves? You're right in that respect. Let's take a look at this page here. This is Investopedia. And it says the average annual return since its inception in 1926 through 2018 is approximately 10 to 11%. But the rule that is often cited is 4%. Why is that? The reason is as follows. The S&P 500 is composed of all equities, or all investments in shares of corporations. On the other hand, when you invest in bonds or fixed income or debt obligations of companies, those investments tend to generate less income and growth over time, but they are less volatile. So whereas if you invest in the stock of a company, that value can go like this from year to year or month to month, week to week, what have you. Generally, if you invest in the bonds of a company or the fixed income securities, then those tend to be less volatile. All right. And in financial planning and investment management, typically as individuals get older, we allocate more of their funds toward the fixed income side or the debt or the bonds more so than the stock. And the effect of that is that the total return is expected to be lower than just being in all equities. So basically, if you're in all equities and you're nearing retirement, you're essentially driving down the highway at 90 miles an hour. All right. And the bond aspect of things is more like driving down the highway at 30 miles an hour. So if you have half bonds in your portfolio and half stocks in your portfolio, whatever that allocation happens to be, the effect is that the overall return expectation is lower, but also the amount of volatility or the ups and downs is also going to be lower. So risk and reward are directly related when it comes to investing. So if you go for high reward, you have to take high risk. If you go for lower reward, then you typically are dealing with lower risk. So when individuals near retirement, this 10 to 11% annual return expectation is generally no longer applicable if there's a significant bond element to their investment portfolio, because that's going to decrease the return expectations and also theoretically the risk over time. So that is why the 4% rule is a lot less than this 10 to 11% annual expected return, is because we're kind of pumping the brakes in retirement in terms of not shooting for the stars for returns, but just trying to preserve capital. All right, so let's visualize this a little bit more just so it's a little bit clearer for us. And I always like to learn visually, so if that's you, this is going to become a whole lot clearer. Now, let's pretend this is the value of your investment portfolio over time. All right, and let's pretend that this point right here is retirement. All right, so let's go ahead and label that. All right, so now this is assuming that there's no drawdown, right? So your investments are gaining value over time, and then you retire, they continue to gain value. This is without you taking any amounts out. But let's pretend you start to draw 2% out of the portfolio every year, right? So in that case, if this happens right at retirement, what can happen is the value of your investments can start to change in terms of the year-to-year increase in value, because now you're drawing down some of those assets. So let's label this here as no distributions. Okay, and then this would be, let's say, 2% distribution. And this might be, let's say, 4% distribution. All right, so as you can see, what can happen is if you withdraw too much of the value of your retirement assets on an annual basis, what can happen is you could start at that million, next year you have 900,000, next year you have 800,000, but wait a minute, there's a market downturn and then the stock market drops 40%, you still need to withdraw assets out of those accounts, and you could see how you can very easily get into a cash crunch situation. So the theory behind that 4% annual distribution is that sort of a cookie cutter, safe bet approach to ensure that you don't get into a situation where you start drawing down your retirement assets. Now, does it guarantee that you're going to avoid the drawdown? Absolutely not, because you may still end up in a situation where that would still be applicable. Let me make sure you guys can see this here. But the idea is to reduce the chances of that happening, and that's where the 4% rule comes from. So thinking about it in terms of stock market returns isn't really going to get you there, because, again, that bond element, that fixed income element, is going to protect you from the downside. So less returns, less risk. That's typically desirable in retirement. So hopefully this wonderful visualization, only the best for you guys, adds some clarity to this whole thing here. And going back to the question, let's make sure we covered it. All right, so that's where the 4% comes from. It's just a guideline. It's boilerplate. It may or may not be applicable for you, but it's a rule of thumb, if you will, in the investment and financial planning space. It's a starting point. But it's important to define what retirement means for you to determine whether that is applicable or not, whether 5% is applicable, 6%, 1%. There's some projections that need to be done to really customize this for each individual out there. But that's the reason for the 4%. The other question here has to do with the $40,000 being less than you spend yearly while you are employed. And really, it's a matter of not so much spending in retirement what you spent while you were employee, but the question becomes, what kind of lifestyle can your retirement funds afford you in retirement, right? Because, again, we have that 4% arbitrary rule of thumb limitation. And if you start just withdrawing 8% or 10% or whatever you were spending while you were employed, that may trigger that drawdown. So essentially the challenge is to get your retirement funds to the point where that 4% will pay for all of the expenses that you have. So it becomes a function more so of what you contribute to the accounts than what amounts you eventually want to take out. Because if you have large enough retirement accounts, then it may very well be that 4% will represent more spending than you have while you're working. All right. But if you have limited funds in retirement, that's going to put downward pressure on how much you can actually spend on an annual basis. All right. So it's a matter of thinking how you can maximize the value of those accounts while you're still working. That's going to give you the most bang for your buck, if you will, in retirement, because you won't be limited by that 4%. It's not going to put you in a precarious situation and a different lifestyle than you're used to. All right. So hopefully, Danny M094, this adds some clarity to the overall situation, the 4% rule, where it comes from, and what it's all about. And if you're watching this video and it added value for you, feel free to subscribe to the channel, hit that like button, and hit that bell icon to be notified of future videos, because there will be more. And drop a comment in the comments area. I love reading your comments, and whatever questions you guys ask, I'll be more than happy to answer them in a future video. With that said, hopefully this was helpful. Thanks for watching.